And I'm John Seacrest. The goal of my efforts is to try and get the ecosystems to go a little bit faster. And so we've been doing the work in Seattle for a decade, trying to grow new things, which have resulted in Grub Stakes, Sea Change Fund, Flying Fish Ventures, and First Row Partners to expand our ecosystem. We've helped San Diego, Kelowna, and Alaska get angel conferences as well. And now we're starting to look at the Iberian Peninsula as the place where we'll add some more. If you have friends and family that are interested in either being angel investors and never thought about it before because they didn't recognize that they were accredited, or you have startups that are trying to figure out how this thing works, we would be glad to have introductions. The Seattle Angel Conference 22 is coming up in the fall. That's why we're doing so many workshops in the summer. So the deadline is the last week of August. And so I posted that link into the chat. If you can't find it, let me know. And then we have Paul Martin here from 10 Capital Network in Austin, Texas. And he's been very active with a podcast and been active on the Kretsu syndication call. So we've been interacting a lot. And he's thought deeply about angel investing in a way that a lot of people haven't. And so I'm really pleased to have him here to talk a little bit about this. You know, when you're cultivating a deal, what the expectations are sort of related from a stage point of view. So Hall, if you would introduce yourself and then just dive right into the conversation.
Sure. Thanks, John. And thanks for having me, and looking forward to catching up with everyone here today. So make it be an interactive presentation. So ask questions as we go along. My background is I've been an angel investor for over 20 years. I started 3 angel networks in Texas back in the early 2000s. Then started a company that basically works in the same space, seed, Series A, and with angel investors. And so we do a lot to help startups raise funding, and we do a lot to help educate investors about the process as well. And stage expectations is an interesting topic, because I find in the investor world, there's some standards that most of the investors adhere to, but sometimes the startups adhere to those and sometimes they don't. And then there is some variation with types of deals. When you get into the biotech, the pre-seed and seed is a little bit of a different game, and I don't dive too much into that here today, but realize stages do change a little bit from one sector to the next. And it also changes from one market to the next. Last year, people were raising on seed and pre-seed rounds that they probably couldn't raise on this year. So the market does change and move. I put in the chat box the link to this presentation. If you want to grab that, you're welcome to take that and follow along with it. So with that, let's go ahead and dive right into this presentation and get going and see what we can see here as well. So, as John says, startups go through a series of stages from launch to growth to scale. And the fundamental idea is that at each stage, there's a different goal to be achieved. And so at the pre-seed stage, what you're trying to do is help develop an idea, research the market, and build a core team. At the seed stage, you're starting to build the minimum viable product and test the market. And I create a stage called Seed Plus. Some people use that term, some use other terms, but almost all the startups I deal with, from seed to Series A, there's another round in between there. And I think it doesn't get as much attention as it should, because I find in the Seed Plus is when we're actually taking the MVP and we're actually moving into the market as a standard product, and we're getting close to product market fit. Then there's the Series A, where they're raising money to provide growth capital to take the product market fit on up into a high growth curve. And then you get into this thing called mezzanine funding, which is debt funding that covers additional expenses. And sometimes this is called Series B, and sometimes it's called mezzanine funding as well. And then on up, you get into IPOs, where you're actually going public on the market or being bought by another company as well. So there's a different goal at each stage along the way. And so typically when you're starting and you're at the pre-seed level, you often go out and get family and friends money. And what I find is a good use of that is to actually set up the business properly. You actually establish a legal entity. If you're going to be raising funding, you have to have either an LLC or a Delaware C corporation. You need to set up accounting books, make sure that from day one, everything is captured into a system. You need to file a word mark for the company that you have there. And you need to build a simple website, because in today's world, if you don't have a website, you don't exist. And you really need to start getting the word out on your business and building networks and partners and relationships that will carry you forward. Get your business cards printed up, and most often important is file some provisional patents. I find that most people wait till after the fundraise to file the patents, but I find patents, half the value is with investors. You should be filing them before. And the strategy is to file 5, 6, 7 provisional patents, giving yourself a year to figure out which ones are going to work and which ones are not. And when the year is up, you can then file a full patent on the 1 or 2 or 3 that really makes sense to go forward with. So there is a role for family and friends funding, and getting the basic setup of the business is a good place to set that up, in addition to your own funding as well. So one thing we talk about is you need to be in a place where you can actually build a business on top of what you're putting together. So as you go forward, each stage of the business has a different work for the product. So in the pre-seed, you're researching the market to identify the customer care-abouts and the product features, and you're looking for that opportunity, and you're looking at a lot of different markets and a lot of different angles into it to try to figure this out, and it's a stage unto itself. And then at the seed, you start to build the MVP and test it with customers. I find a lot of people skip this stage. They go straight to the standard product, and then sometimes we build the right thing. Most of the time we don't. And so having somebody build a proper minimum viable product and get cohort testing out of it is a step all unto itself. And then I find there's a second step there where you're taking the MVP and you're creating a standard product. Sometimes that's just a tweak on the MVP, but most of the time that's throwing the MVP away and just building a whole new product, because the lessons learned show you that it is just going to be very, very different. And that's fair game. And so in your fundraise strategy, budget time and effort for a seed plus raise. I find that's a step most people don't plan for, but they end up doing it somewhere along the way. And then at the Series A, you're starting to find product market fit. That's the real goal there. And now you're starting to see growth outstrip your supply, your ability to keep up with it. The demand is going faster than you can go. You probably have some form of product market fit going on there. At Series B, we're raising money to start scaling up the business. And so now we're putting in systems into place to really grow to that next level of revenue that goes there. And then when you get to Series C, what you're actually doing is you're expanding into new markets with new products and new geographies. And so Series C is about expanding the product line to be broader and more encompassing to get out into new areas as well. If we had room for a Series D, I'd say that's about acquisitions. You would then start to acquire other companies to be a part of your company, to make it bigger, fill in the gaps that your product didn't fill, and get ready for an exit or an IPO or some later stage activity. Let me stop there and see what questions people have, and let's jump into it. I see a number came in on the chat box, but does anybody have any questions from me already?
Most of the chat is just me putting in extra data. I don't think anybody else is putting questions yet.
Okay.
Can you talk a little bit about, the check size that you're thinking about at each of those things? Because we heard someone say they just did a 250 seed, and somebody else said they did a 1 million seed, and we've heard in the Bay Area people doing $20 million seeds. Yeah, all right, you've already got it. Next step, all right.
Right. So yeah, lucky me, it was the next slide. Sometimes it's not, but these are the numbers I see. And like I say, this will vary based on what you're doing. Some people are on the unicorn track. You can basically add a 0 to every number you see up here if you're trying to do the unicorn mode from day one. And some people are in the biotech track. Again, you could probably add a 0 to every stage of this because of the cost of IP and clinical trials and things that go with it. But if we take those off the list for a moment and just look at, most of the businesses that you guys had described here today, I find people are raising 250 to 500 for a pre-seed because we need to get out there and do some basic testing and start building the core team and file some patents and do that sort of work. And that's great. That's what we normally see. At the seed, I see people raising $500 to $1 million. Now, I will tell you, almost everybody that comes to me wants to raise $5 million at the seed. That's the first thing they tell me when they meet me is I want to raise $5 million to kick off my company. And I have to coach them. Well, if you raise $5 million at the seed level, you're giving away a huge amount of equity that you probably don't need to. And for pre-seed and seed, we need to be thinking about minimum viable product, minimum fundraise, minimum team, not maximum raise, because you want to, as you grow the business, you want to raise your valuation. So you're raising what you need for each stage, and you're not trying to compress the entire thing into one fundraise up front. As much as that sounds easy, it is not, and it's probably not a good idea. So we're going to be raising in steps and stages. At the Series A, I see people raising $1 to $5 million on average for what they're trying to do. Again, how much money you need to build the business varies from one business to the next, and how much hardware or software that needs to be developed to achieve the growth, it also varies from one business to the next. At Series B, I find they're raising $3 to $15 million to start to scale the business up. Series C, they're raising $5, $10, $15, $20 million in most cases. And then when you get into Series D's, IPOs, they're raising usually $50, $100 million in most cases. And each stage has a different goal. With the pre-seed, we're setting up the business. Seed, we're building the MVP. Seed plus is basically another seed at $500 to $1 million to build the product, to go into market and really establish it as a stand-up product. And then Series A, we're trying to start to grow the company rapidly. So we're starting to put in repeatable processes and so forth. And then Series B, we're putting in scaling processes. And then Series C, we're using this to build new products and go into new geographies. We go international with it, et cetera, and so forth from there. If you go to the next one.
I want to sort of step in and reemphasize something that you hinted at. We just did a pitch deconstruction workshop, and in that workshop, we had people who were basically pitching their product, not their business. And they wanted money because they wanted to work on their product. And when you're raising money at these levels that you're articulating, really what I think you're talking about is raising money to change the value of the company, to expand things and to have milestones that are milestones in terms of company valuation. So can you sort of relate these fundraising numbers to the valuation numbers and how those fit together?
Sure. So, yeah, you're right. At each stage, there is a range of valuations that investors are expecting. And so in the pre-seed, which you usually don't hear much about valuations there, but especially if it's family and friends and your own funding that's doing that, it's very low, because all you have at the end of it is basically a market research report and maybe some interested customers. But when you get into the seed, that's when you start to see people that are usually in the $2, $3, $5 million valuation range. They're somewhere in there, given what they have so far. We have different ways of doing valuation, but if you look at the market in general, they're usually in there. And then when you get to the Series A, they're usually in the $5 to $15 million. And now it varies based on, do you have recurring revenue? How much hardware is in there? What are the gross margins you've got? What sectors are you in? How fast are those sectors are growing? And so it can range a little bit. If you have recurring revenue, that's a 10 to 15x times revenue multiplier for the valuation we see today. If you can put data analytics and AI in there, you start to increase it even further. So that's why there's a bit of a broad range on those valuations. When you get to Series B, we start seeing 20 to $50 million valuations. Series C, 50 to 200. Then when they're IPO, they're 100 million plus that they're going out at and more. So these are some of the ballparks that we see people coming at. The key with valuations is you just have to have the justification for the valuation you're putting on it. But realize if you're too far out of the window here on these things, it's going to be a tough negotiation for sure.
So we were talking with Flying Fish, with Jeff Harris at Flying Fish. He said of the 7 companies that they invested in that then went on for their next step to get funding at a Series A level, that all of them, 100% of them had done the second series seed fundraise, right? They took the 500K, and then that 500K, they got to the end of that, and then they raised another 500K before they really were prepared to do what the Series A institutional investors were looking at.
Right. I find it very common because for two reasons. One, to get the valuation you want at Series A, you have to hit all the metrics that the VC has for you, and that's rarely the case. You have to go back and raise more money because there's 2 or 3 metrics that you're not hitting, and they're not putting in the money until you do. And so you have to go back and do it to get the valuation you want and hit their metrics as well. And two, sometimes finding true product market fit is more elusive than you thought. You had a good growth spurt and then it ran out. Well, maybe we thought we had product market fit, but we really don't. The product needs to be bigger, better, and whatever. And so we need a little bit more money for it. That's why I always coach people, have your seed, but then just do another seed plus, same term sheet, same valuation, all that the next year, and just get that MVP fully solid in the marketplace with all the metrics that you need.
So you're expecting these fundraisers to carry them a certain distance.
In most cases, we're expecting it to go out 18 to 24 months. That's assuming it's, you raise all the money that you expect to raise. That is one assumption to be careful about. Not just because I'm going to raise $1 million doesn't mean I'm ending up with $1 million. Sometimes I come up with 750 or 800, and you have to have a contingency plan for how you're going to handle that, or it's just going to take a little bit longer to get there than the original plan had in mind. You have to watch your cash burn in those cases. But you're right, there is a certain time frame in which you need to get things done.
So any questions from anybody in the audience? Feel free to post things into the chat. Feel free to raise your hand now.
Yes, I have a question. So correct me if I am wrong. So my understanding is that in pre-seed and seed, like the focus from the investors is on the product, the team, and the market fit. And as you mentioned in the Series A, like you start to look for more like metrics. What would be like the metrics that you will be like looking for?
So at the Series A, you're looking for growth metrics. You're looking for a gross margin. You're looking for ARR growth. How fast is the annual recurring revenue going up? How good are your gross margins on it? Are they getting better? Are we getting more efficient at this as well? And then you're also looking for, CAC LTV ratios start to become meaningful at that point because you're getting a little bit of scale going on with it. So I'd say those are the metrics we're looking for: is growth, margins, and CAC or customer acquisition to lifetime value metrics are the key ones there.
Amazing, thank you. And what would be like a reasonable like growth ratio or CAC LTV? Is like doubling, tripling, like the growth like year over year, and like CAC LTV would be like 3:1 relationship?
And so for growth, I find that for the venture world, you need to be growing at least 50% year over year minimum. If you can be doubling year over year, you're really in the sweet spot. So somewhere between 50 to 100%. When you show up with 15 or 20% year over year growth rate, people are going to start to wonder, is this really a venture deal? So you really need to get above 50% on that one. For CAC LTV ratios, when you're in the seed stage, 1 to 3 is a good number. For every dollar of customer acquisition, you get $3 of lifetime value. When you get to the Series A, they're really looking for 1 to 5, 1 to 7. So you need to be having some more efficiency in that customer acquisition process. You've been doing it for a little bit of time now, so you should really know how best to get the most customers for the least amount of money. So 1 to 5, 1 to 7 is what I see at the Series A.
Amazing. Thank you so much. I really appreciate it.
So when you think of the value of a company, I have an idea and I have some crappy piece of code and I have half a team member with me, and I'm trying to figure out my valuation. That's fundamentally a different task than I have customers, I have revenue, I have week over week growth in revenue. That's a percentage, like 3% week over week growth in revenue. Is a fundamentally different space than I'm dinking around with things and I haven't got flow, right? So when you get to your Series A, the institutional investors want you to have all of the MBA formulas functional. And so all of those things fall into place. So everywhere you have an MBA formula, whatever the things in that formula are, the numbers that come out of those need to have meaning. When you're at pre-seed, there's absolutely no meaning to that, because your predictability of revenue is random for the most part at pre-seed. Am I characterizing that right, Hal?
That's right. You know, when you go to institutions, they really do have to check mark all the boxes. There are no more gimmies that family and friends and others give you. You really have to have the business up and running, and you're check marking it, which is why I think that's more than anything what drives Seed Plus raises is the fact that I'm missing 4 of the 10 boxes that need to be checked. You know, they're not far away, but they're not there, and VCs are very unforgiving about that. They really want you to be there, so you have to raise a little bit more money. Usually more from the angels is where you do in that case, and you're trying to get those metrics figured out, because be candid, you know, when you start a business, it's everything's skeletal. It's a skeletal team, it's minimum product. There will be gaps in the business, and now we're in the process of gap filling to get to that Series A that we want. And then some people have a vision of a certain valuation, and they really want to go with it. And the VC will say, well, to get there, you have to hit these metrics. And so they're not saying no to your valuation. They're just saying you have to earn that valuation you want. And that also drives a Seed Plus raise.
Can you talk a little bit about the consequences of raising too much at the wrong stage?
Oh, yeah. Well, that's a very good one, very timely one, as we just come out of a very frothy market in 2020 and 21, you know, where people raised at very high valuations. And so, like I say, everybody that comes to me that wants to raise funding for the first time tells me, I want to raise $5 million. And I think they actually want to do that at their seed round. And I think, well, you know, that's a lot of money to raise there at that point. And if you do, realize you want to stair step this process up. And what I always have them do is visualize not only this round, but if you raise it, what will be the next round? And typically you want to double your valuation from this round to the next round, ideally. So if I'm at the seed stage and I'm raising at a $10 million and okay, the next round needs to be at $15 to $20 million. And then ask yourself, what's the revenue I need to raise at that next round to get my $20 million valuation? Well, I need probably $3-4 million. And then you look at what revenue you have today. I have 50K. And then ask yourself, in 24 months, can you go from 50K to $4 million? And it starts to dawn on you, you probably cannot. You probably will not grow that fast. And therefore, I'm head over skis on this. I'm actually raising too much money at too high a valuation, because I'm not going to be able to keep up that pace going forward. And then we're in some cases up for what we call a down round, which means the next one's going to be lower than the previous one. And now you're going to have some very unhappy investors who, quote unquote, overpaid in a previous round. So we saw that a lot last year where valuations got very high. I think we saw that mostly in later stage companies, Series C and D, where they're raising at the $100 or $200 million level. Those guys are in for a 20% down round of valuations. Some do it to themselves because they know it's going to come. And so the idea is, in the very early stage, I see less of that. Sometimes it happens. People come back and they say, well, I was able to talk an investor into a $10 million valuation for what is a very small amount of revenue. And I think, okay, you know, are you going to raise on the next round in 24 months at $20 million? Will you have the revenue and the metrics to justify $20 million in 24 months? And they look at me like, well, I'll worry about that later. Well, I would worry about that now, because you're making decisions that are going to make it very hard for you later to raise funding at an up round. And if you have to go through down rounds, sometimes you have to, but it is almost nuclear to some of your part of your cap table when you do that. So even if you can raise more than you than the standard. I caution it because think of the long game of having to keep up the rate that you're currently talking about, and in most cases, those markets just don't last forever. The pandemic market lasted for 2 years. It was a great 2 years, but it's now over, and we have a very different valuation scheme here today for sure. So these markets don't last all that long.
Any other thoughts? Okay.
So do we have any questions in the chat box?
Not so far.
Okay, great. Cool. So if we go on to the next stage, what you'll find at each stage of the fundraise, there's also a different financial work to be done. At the pre-seed stage, what you're really trying to do from a financial point of view is try to identify locked value in a customer segment. You're doing the math on what people are paying, what they're getting, and where the opportunity is for you. At the seed plus stage, you're identifying a case for the business and refining an initial business model and a financial model. What are we going to be, how do we make money doing this? And that's comes out of the seed plus categories. When you get to the Series A, this is when you're starting to build a standard ongoing business. And the metric we use is return on invested capital. You're looking for, am I actually making a return on the invested capital? The investment that came in from outside and the profit that we reinvested, is this turning into a 50% or better invested or return on invested capital metric? That's what you're trying to do there. And then Series B, you're trying to build a business model that actually scales with the business. And somebody wants to ask me, what does it mean to scale? That means that your revenue grows faster than your costs. You've got systems into place that you're not just growing revenue at the rate of the cost, you're growing it faster than the rate of cost. And so if you have recurring revenue and you have other factors, prepayments and other factors that give you an increase of revenue faster than your cost, then you've got a scalable business. A consulting business, for example, is not scalable because revenue and costs grow at the same rate. The lines are parallel. And so that's what you have to start doing, is building elements into the business that gives you that scaling factor into it. And then at Series C, the financial work goes into acquiring other businesses. We're looking to see who else can we buy to join our company. And so the financial work shifts a little bit to the outside of how do we fill gaps and how do we find other companies to acquire for it. And then IPO is about building a war chest to go into new markets and do new things altogether. Any questions about that?
I have a question, Hal. Can you share maybe some metrics involved in these? Like what kind of revenue targets each of these stages have?
Sure. So at the pre-seed, there's typically no revenue. At the seed, we're usually going from 0 to about 500K of annual revenue. Series or the seed plus, we're going from 500 to 750, maybe $1 million. And then Series A, you're usually at a $1 million revenue run rate is what you're at. Series B, you're usually hitting that at about the $2.5 to $3 million revenue run rate. And then Series C, you're usually at the $15 to $20 million run rate when you really start to think about that. And maybe it's a little bit later. And then IPO, you're usually at the $50 million run rate. So, and this varies from the type of business one to the other. Biotech, this would be very different because we have clinical trials going on instead of revenue for some of these stages. But we're not going to get into the biotech thing here today. But does that answer your question?
Yes, it was annual, right? Not monthly.
Those are all annual numbers is what we're seeing there. Yeah.
That's very helpful. Thanks.
So let me suggest that it's important from a founder point of view that while the annual is the right number, you should be thinking of the monthly and the weekly versions of that, because you need to manage them on a daily basis, not manage them on an annual basis. And so when you're doing the triple or the 10x company, what does that mean for a week over week growth rate? you should know what that is, and you should look every Friday morning. You should go look at your financials and make sure you're achieving what you expect to achieve. And if you're not growing on a week by week basis, then you don't have control of your engine yet, right? You haven't figured out what the tools are. And if you don't have a financial discipline to follow your the ratio of your projections versus your actuals, then you're going to get yourself into a corner someday. So another point, when you think about when is the right time to apply to like the top of the angel groups in Seattle, I tend to argue to people that their monthly MRR should be around 10K when they apply to the top end of the angels. The bottom end is a different group of people, but the top end, it's about 10K, right? But if you're at 100K, now at 100K, now you're really more at a Series A level, not at a angel level. And now that's a good time to go look at, you know, lighter capital, or that's a good time to look at some of the smaller VCs. Is that true in Austin as well, Hall?
Pretty much, you know, the angels have moved up the curve quite a bit from when I started. You know, there's a saying today that, private equity is the new hedge fund. VCs are the new private equity. Angels are the new VCs, and crowdfunders are the new angels. And in the funding world, that's what happens. You know, people move up and to the right. They move to later stage and bigger deals. And I find even today, angels really want a little more professional, polished deal than they did 10 years ago when I was leading the groups. And so I think that's the way it is today.
I think that every stage has groups that split. Some go down and some go up. And so we have venture capitalists that are now writing pre-seed checks with some part of their money, while at the same time they're going up in terms of the expectations that they have for those companies. Yeah.
Right. And so the next slide here talks about investors by stage of funding. And so at the pre-seed, it's usually founders are funding that research and maybe a little bit of family and friends. Then at the seed, you get family and friends and, you know, closely known angel investors, people that you know very well are coming in at that stage. And then at the seed plus, you get angel investors and early stage venture capital coming in. A lot of VCs really want to see $1 million of revenue, but there are micro VCs, sub $100 million venture funds, you know, $25, $50 million that will come in pretty much where many of the angels come in because they want to get a good valuation. They want to come in early. I find the sweet spot for a lot of investors is in the $500 to $1 million range because of revenue. Because if a company is growing fast, it's not going to be long before they hit the $1 million. And if they have really good numbers, they're going to get a lot of interest. And so some people jump in a little bit earlier than $1 million just to get in the deal and get a valuation that can be less than what it will be later. And then Series A, that's where venture capitalists really come in and start to do this. And what I call late stage angel investors come in as well. You meet angel investors all up and down the curve. Some are very risk-taking, some are very conservative. So not all angel investors are the same. Some are early and some are later. And the more conservative ones want to see $1 million and want to see all the boxes checked, just like the VCs do. And then the Series B, you know, these are later stage venture capital. We start getting into what we call growth equity investors, where they really want to see $3 to $5 million of revenue, and they're looking at the path from there to an IPO or to a next secondary or some mode like that. And they're often called growth equity investors. At the Series C, you get into mezzanine investors. These people are putting in debt. In some cases, because when you get to this stage, entrepreneurs really don't want any more dilution. And so they start moving away from equity into debt, and mezzanine shows up. And then some of the growth equity investors are continuing to work there as well. And then we get near IPO, then you get a lot of pre-IPO and secondary investors that are coming in. So you deal with a different group of investors at each stage along the way. And that's important to know. If you are raising funding, you want to look up the investors that you are targeting and see, do they actually invest at my stage? I think half the reason we get rejections is because they do Series A and we're a seed company. Okay, well they're never going to say yes until we get to Series A. It may make sense to go talk to them to build a relationship, get on the radar, and start that process. That's a good thing to do. But to expect a check when we don't meet their criteria is probably not a good expectation. So with Crunchbase and the tools that are out there now, it's really not hard to figure out where these investors are and then to match them to what you're doing. I do find a lot of startups, even though we have this list up here, they really go by their list. If mom gave me a check, dad gave me a check, so I must be on my Series B now. So you have to, not just put your nomenclature on it, but look at it from the investor side as to how they're going to perceive it. What are they going to expect when you show up at that your level, and does that match their criteria?
So we're talking a little bit about angel investors and VCs as though they're all sort of homogenous and uniform. And there's a certain amount of idiosyncratic behavior among both angel investors and family offices that you see that are quite different than venture capital. And so, you have to understand there's variation in here somewhere. And one of the big variables, I think, is the notion of top-down investors versus bottom-up investors. Do you track things in that set of vocabulary?
Well, so I see what you're saying, but the way I find it is some investors are, financial investors. You have to hit the numbers, and then I'll put money in. That's more of a bottoms up. Other people want to give back to the community. They're an impact investor, and you have an impact going on in the deal in addition to the financial return. So they're investing for other reasons. And so when you get to those other reasons, you can start to see people doing the top-down thing. And especially if they believe in the team hits all the check marks all the boxes, well, then I'm in. And so they just focus on one or two key variables and they make the decision based on that. So there's many different ways angel investors approach it. And that's why it's important to kind of build a little bit of a relationship and to figure out what the investor's interested in. One thing I found in proposing deals to investors is that there's many ways you can pitch the deal. I can get 6, 7 positionings out of a deal. An ed tech company came to me once, and so we went to our ed tech investors and said, here's an ed tech service deal. Well, then I noticed that they had recurring revenue. Well, I have investors that's all they do is just do SaaS deals. It doesn't matter what we're selling, but as long as it's got the right CAC LTV ratio. So we repositioned it for the SaaS investors and put the CAC LTV on there and proposed it that way. And then we noticed that they were also graduating students in a bigger way. And so there was an impact investment that was on top of it. So we repositioned it for our impact investors. So when you come up with your deal, look at all the different positionings and think about positioning it for the investor you're going to. One of the things I find with angels is that their capital preservation is a thing. And so that's why they really want to see some revenue in there and they want to see some proof. And so they'll take a lesser return if they are more sure that it's just not going to go under. On the other hand, I find many VCs, if it's not 10x, I don't care. It doesn't matter. And so they'll take flyers on some deals if they think they're a 10x, knowing that some number will be. And there's a theory that every deal they invest in has to be able to return the entire fund because you never know where it's going to come from. So they do take different approaches at this investment game, and you want to kind of know a little bit about that in order to position your deal for those investors that come out. So when I go to angels, you want to show that this is proven, it's working, it's not going to crash, it's not going to go bankrupt. When you go to VCs, this is a big market, it's a 10x at least, and it's a rocket to the moon, come join the ride. And so there's different ways to promote the deal based on who you're talking to.
So Joseph is expressing frustration, I'll say, with the notion of very early expressions of traction as an expectation from investors. And I'm doing my little lean startup customer development versus product development soapbox in the chat. You want to talk to the question of what we mean and what we mean by evidence of things at the different levels?
Right. So, investors say they invest at a certain stage, but unless it's a super strong deal, they're really not going to invest until it's probably a little bit more proven thereafter. They start to get conservative with it. And I think at heart, some investors are saying that, if I'm really a Series A investor, I'll just say I'm a seed plus. That way, when people get to C plus, they come to me and I can start to evaluate the deal. If I wait till they get to Series A, the line is out the door of other Series A investors. I don't want to be at the back of the line. So they're trying to get in at a little bit earlier than everyone else is at their game because they want to see it before everyone else does. So if you go to them at the seed plus, the line is shorter. There's fewer investors. They have more negotiation power. They have more, ability to get in and influence the terms and so forth. So I think some investors play that game a little bit of wanting to get in an earlier look than other investors that they normally deal with, and that's why they say they're seed or C plus when they're really a Series A. I think that when they say they want revenue, I think what they're really looking for is market validation and product validation. There's somebody using it, and there's some they validated the fact that people will pay for it in some way. We sold a customized version or something that can validate it, can be something beyond revenue. It's just finding those validation points is the challenge for many startups.
So I think I'm going to do a little soapbox. One of the things that people come to us is they say that they've talked to a lot of customers, and then you say, well, great, how many have paid you? And they say none. And then you say, wait a second, that paid you. So people don't do the customer development work to validate that people are willing to spend money to solve the problem. Has nothing to do with the product, has to do with the problem, right? They haven't qualified their customer base. And they haven't qualified their customer base to the point of understanding the sub-market that will move, right? Not the sub-market that in the future will be interesting, but the one that's interested now that'll pay them, that'll give them momentum. So that conversation about what is actually a customer versus what is somebody that I talked to that had a random shirt on is fundamentally different, right? And so when we're talking from an investor point of view and they're talking about you've engaged with customers, they really want to know that there are people willing to pay, not people they're willing to talk to you. Am I on the wrong soapbox here?
No, I see that a lot. I think one of the things I coach people on is you should really think about what we call anchor customers that will pay maybe a little bit of a custom price. You get a little bit of a different version of the product, but they're validating that there is a market, people pay good money for this, and you can use some of that money to actually build out the product as well. You should have to go find these customers that need something a little bit unique and they're willing to pay a nice price for it. So if you plan to have a product for a standard price of $5,000, for the low price of $150K, I'll build you a custom version, put a few extra features into it, and then now I've got a successful customer of my technology, and I've got lessons learned from them as well. And I've also got a great reference up there that says they bought the product and they're happy with it, and you can talk to them all day about it. So I think finding reference customers is one solution to that problem. And it's also helps with the funding, because the money they're giving you goes into product development. It doesn't go into anybody's pocket. It goes into product development to build that product out in a bigger, better way. And that's non-dilutive funding as well. I call that non-dilutive funding because you're not giving equity to the customer. You're just giving him a version of the product that he really wanted. And that makes a big difference with the investors, because you're now generating revenue, you're closing business, you're building product, you're doing all the things you need to be doing.
Yeah, so for customer number one, it makes perfect sense for $150K to develop a specialized version of a feature that solves their problem. And then for customer number 10, you gather 10 of them together and charge them each $15,000 and do the same thing, but find a commonality of features that are across them. And now you have momentum and you're walking down the path so that your $5,000 price later makes total sense. And you've already got your 15, 20 customers in tow before you hit the $5,000. That's a perfect good answer. I love that answer. Thank you.
Right. Well,
Any
the
other
key
questions from folks?
yeah.
The key is what?
Well, the key is when you're building the product, you're taking on these custom customers. You're building the one platform standard product. Everything's in the same code, architecture, language. You're only licensing it out to them. You're not selling them the code. You're just licensing. So everything goes into the standard product. So by the time you get to your fifth customer, you pretty much have a standard off-the-shelf platform. And then from then on, if somebody wants a feature, though, they're paying for you to expedite that feature into the platform. Give me 50K and I'll put that feature in for the next version. So you have that, as opposed to trying to do something custom for them. So we don't do anything custom. We've already defined the architecture and the platform, and everything is developed. And if they can't live with that, well, then we're not taking them on as a customer as well. But you can monetize features in that same way, where people come to us and they say, I really need to have these two features. Okay, well, pay us a non-recurring engineering fee of $50,000 and we'll make that part of our next revision. And that money then goes into paying for the development of something that you were going to do anyway. You typically don't do anything you don't have planned to do at some point anyhow. But if you do, having some customers pay you to do it early is a great way to get more funding as well.
On the other hand, sometimes your feature list is invented out of your own head. And if enough customers are asking you for it, you probably ought to change your feature list.
That's a great way to do it. It's you're getting real feedback from real world customers. I also find when you anchor client customers, you start to figure out why they didn't choose anybody else. Well, there's no other product that does what we want, and there's no other, or the other solutions don't meet the needs, and here are the top 5 reasons why they don't work. So they're doing a lot of market research for you. They're telling you right up front what you need to do, and when the customer's telling you that, and they're putting money on the table, you know it's the right thing to do.
But we're going to get from the entrepreneurs that they talked to 10 people and none of them wanted to pay for features, so they really were going to discount people to come play with my prototype so that the beta is free and all these kinds of things. Do you think that that's a pathway that's workable?
I've seen that pathway work, and where I saw it work is I used to go coach at the South by Southwest Accelerator, and there for a while, everybody had the same business model. They put on the mobile an app that had a shrunk down version of the product that they gave away for $5 or sold for $5 or whatever. But what they really made money on was the packaging up the technology into a $50,000 to $100,000 annual enterprise license. And the value of that freebie or that $5 version is that's your beta cohort. If you ever want to ask for feedback or features, you go out to them. You don't bother your paying customers. You go out and get that cohort to test features out for you, see how it works, get their list from them. And whenever you're rolling out a new thing, before you roll it out to an enterprise customer that may have a lot going on with it, you go test it out on that community, so to speak, that you built up. So I've seen some people make use of that low-end marketplace, but it's primarily for market research. It's not for money and not for monetization or whatever. You really wanted to figure out, okay, well, these are the features people really need, and this is how it really needs to work. And then when you have it built, you roll that out to your enterprise customers. So you can have different type of customers out there and use for different purposes. But in general, I always coach people, what you should do is go and find 3 anchor clients and negotiate a custom version that fits what they need, that is in your roadmap path anyway, and have them pay you $150,000 to $250,000 each. If you have 3 customers pay you $250,000, there's $750K of funding that's going into your product. And of course, they're telling you exactly what works and doesn't work, and all the things you need to know to make that product work. And you're building it with a vision of making it a standardized product at the end of the day. You have to drive the architecture very hard in those cases and not let people take you off into another direction, for sure.
I like that path. Other questions?
So the next thing I had up here is boards and advisors by stage of funding. When you're going through, if you're at the pre-seed or up to the seed plus, you really don't need a board of directors. That usually comes in at the Series A. But what you can do is recruit informal advisors. We're not paying anybody anything. And informal board members, which means they're advisory board members. And they're there to give you domain knowledge, basic business advice, sales and marketing expertise. And these are, 2, 3, 5 people. It's not a lot more than that unless you really need a lot of different things to support you. When you get to Series A, this is where you start to build a formal board of directors. And what you do in this case is you're looking for people that can really help you provide sales growth expertise. And typically a board at Series A is 5 people. It's 2 people from the company, 2 people from the investors, and 1 that's independent. That is typically a domain knowledge person. They know the industry very well, and they're there to talk about the industry side of it. So at Series A, that's when you get into that. When you get into Series B, you have that formal board of directors, and then you start adding a few advisors onto it that start to talk about scaling expertise and how you get into that. And then when you get to Series C, you're looking for the same thing, but you're now looking for people that can help you expand into new markets. And Series D, you're looking for people that can help you acquire new companies that come in. So there's a different group of configuration for the board. As you go from B to C, you do get a bigger board where you're bringing on Series B investors and Series C investors. They will want to have a place on the board, and so you're bringing them on as well. And then you're having fewer Series A investors come into it, and you may need to have more domain knowledge people if you're going into specialty areas. So there is a board configuration at each stage along the way. If you're doing a pre-seed seed company, think about asking a few investors and others to be informal advisors. And what you do is you just have lunch with them once a month. Make it very simple, very easy. Just go out to a restaurant or coffee shop and catch up with them, ask them questions and get feedback from them, and invite them to help you. In the pitch deck, if they agree to it, you can put their picture and say, so-and-so is helping us in this case, and it'll help fill out the team a little bit for the gaps that may be there. Investors are expecting a domain knowledge person, then maybe an advisor can help fill the gap for you as you raise funding as well. Anybody have any questions about boards or advisors? Cool.
You probably want an odd number of people on the board, and you probably want it to be as small as you can keep it and still be sensible.
Right. Yeah. So 5, 7, 9, these are the numbers you normally deal with. Like I say, Series A is 5, B is 5 to 7, C is 7 to 9. It doesn't get to be too big. But along the way, there are key people that can help you, and you want to make sure they're on the board. And if they don't fit the board model, they can just be an advisor. And when you get to the B, you start to pay people for advisory work. C and Series A, typically not. We're not paying at that point. And then there's success rate by stage of funding. As you can see here, fewer and fewer companies go all the way up the curve from C to Series A to Series B to Series C. But only 12 to 15%, at each stage make it all the way to a successful exit. And the number of people that continue to raise funding drops dramatically. Of all the people that raise a seed, only 40% will go on to raise a Series A. That means 60% are no longer raising. They're no longer on the venture track. When they get to the B, only 25% of the Series A go on to raise a Series B. And then you get to the Series C, it's only 15%, and Series D is only 5%. And so the number of people that continue to make it up drops down dramatically. When I say 5%, that means 5% of the Series D, 5% of the Series C actually raised a D. So it's not of the original number, it's of the previous round. And so the drop off is dramatic as you go from A to B to C to D. It just drops down as to how many people make it. They get to a place where they just can't raise any more money, or it doesn't make sense to raise any more money. And they now become an ongoing business. And some of them go public after a while. Many of them don't. They just stay private for a period of time. And so you have to think about that as well. Let's see. Next slide is about team by stage of funding. I hear this a lot. People always ask, who should I put on my team? And at the pre-seed and seed, I think that at heart, what you need is somebody building it and somebody selling it. So you need a founder and a technical co-founder. No fair, we're all going to be building it and nobody's selling it. That is a recipe for disaster. You have to have both people doing it. Technical co-founder needs to have enough technical skills to actually build product, build code product itself. I wouldn't go and outsource just yet. I'd actually go and build product. And then later, as you go up the curve, the technical co-founder can actually manage outsourced resources and outsourced developers. They drive architectures, they check quality, they prioritize features, and they manage that outsourced developer team if they go in there. So when you get to the Seed Plus, you need a founder and technical co-founder, but the co-founder is turning the MVP into a standard product at that point. And then at the Series A, you have a founder, a technical co-founder, and a product person. Product person can be focused on building the product or rounding it out with all the documentation and other tools that go with it, channel partners, and they could also be the primary salesperson as well. Although at Series A, it's all about sales. So everybody's their number one job is sales, and their secondary job is whatever is on their job description. But you do need to get into a product person that's managing the sales and the channels at the Series A. At Series B, you have a founder, CTO, and a CFO, and the founder is working on scaling strategies while the CTO and CFO are helping scale the business as well. And then same thing for Series C, but now we're actually building the next generation products, or we're going into new geographies. And the Series D is we're now applying this effort to acquiring companies and integrating them into your business at that point. So that's the main work to be done there. Any questions about team and structure, even especially at the early stage?
If we think about the sales funnel in the pirate metrics thing, acquisition, activation, retention, referral, and revenue, then the first three of those are basically content strategy. And content strategy is all about marketing and identifying submarkets and building flow and narrowing the submarkets. And so those examples don't really put quite enough emphasis on marketing and sales skills, right? And so it feels like the job of doing the marketing work, different than the sales work, is underrepresented in most startups. Do you agree that, or am I misunderstanding what you're saying?
Well, I think you can get people that will do marketing work for you, but I find in most of the companies I deal with is that the content still comes from the founder and the co-founder. They're the one that is creating the blog content. They're the ones that's creating the information that goes out. And then there's plenty of people that help you post that on social media. They put it out through the different channels, and it's important to go test all the channels to see where you actually get the best customers, the most customers, and you're testing the cost. What's the cost per customer that you're getting? So at the Seed Plus, I see a lot of marketing work going on out there, but I find that the founder and the technical co-founder are in heart driving that process a little bit with the content and the A/B testing and so forth. And then you hire people that actually do the mechanics of posting and mailing and gathering the results and rolling it up in reports. That there is a marketing component that goes with that for sure. And that's a key point. You do need to have more marketing, especially at the product person would be doing a fair amount of that as well, but maybe more with an emphasis on closing sales at some level.
So, Hall, you have a Twitter address, right?
Right.
And you use it.
Right.
Right. Now, how many people here are raising hands or are raising funds? Raise your hand. No. Do the thing. And I'm sure there's more. A bunch of people are sitting there. Not thank you, Murat. Yeah, that's perfect. And so my goal was to get people that are raising hands to then tell me how many of you have posted on Twitter in the last week. And then what I expect is all the hands to go down, right? And so we have a bunch of people that apply to the Seattle Angel Conference, the meetup group, the meetup Seattle-Angel, who say I'm an entrepreneur and then say I don't have Twitter, right? And if you're raising money, the place where most of the interesting fundraisers are is on Twitter. So why don't you have a Twitter address? And why isn't there a conversation happening there and that kind of thing? And so there's a certain disconnect between the behavior of the entrepreneurs around fundraising and the content strategies that they have around fundraising. Do you see that as well, or am I just in a closet by myself?
Well, I think some people naturally gravitate to marketing and they really like to get out and use the channels and they do well. And then some people don't. They really, can't be bothered to post on Twitter or what have you. And so you have to come up with strategies to manage that process, because you do need to start getting the word out on your business, and social media is a great way to do that. You do need to start building a network and a list or email with newsletters or something that gets the word out to your community and start to build a community behind your product as well. And if the earlier you start that, the better you'll find the business goes, because you start generating support and word of mouth and other things that really make it go forward. So I think it just relates to the people that are behind it as to who naturally gravitates to it. I like to write, so I do a lot of content myself. So I've been doing marketing since the beginning, and that helps us quite a bit, because we have quite a number of people connected to our program now through all the different channels that we work with. There's like 20 different marketing channels out there. We have business calculators, we have e-guides, we have everything. But it takes time to build that stuff up, but we like doing it. But the more you do of that, the better, because the more leads you have, the easier it is to do sales. That's the key to sales, is having good lead generation to fill the pipeline. I've seen some groups, put everything on the salesperson. You have to go generate the lead, you have to go qualify the lead, you have to go close the lead, you have to go and market to the lead, and it can be just overwhelming to them. If you, on the other hand, give them a process where leads are coming in and all they have to do is follow up the leads, they're far more efficient. Having salespeople go do marketing is very inefficient. So it's important to put in marketing processes to support the sales process for sure. Cool.
Any other thoughts from folks?
If in my case, John, if I've already got more demand than I can supply, what good does it go for me to go to Twitter and just have somebody else on the waiting list?
Well, because you have two sales processes. You have two sales products. One is I'm selling oysters. The other is I'm selling part of my business so I can sell more oysters. So you have to make sure you understand which conversation you're in. You would like to be known by all of the venture capitalists, micro VC funds, or all of the angel groups that care about what you're doing. And if they don't know you exist, then when you go talk to them, it's a cold engagement. If you've been having a good conversation about whatever, right? About the health of oceans in Alaska, about fish, about whatever, and they're paying attention to you, then when you come and ask them for advice about your business, you'll get a different response than the cold response.
I can see that.
I mean, the number one problem that we have with pitches is that people pitch to us, the investors, the product, and we are not buying the product, and we never are going to buy the product. So like 80% of their pitch is product, when it should be like 20% of the pitch should be product, and 80% should be about the business and the market and where it's going. Same thing with your Twitter process. The Twitter process should be attuned to the audience you are intending to engage with. Am I on course, Hall?
That's exactly it. The number one problem is startups pitch. They treat the investor like a customer, and how the product works and why you want to buy it and so forth. And out of a 10-minute pitch, 9.5 minutes are on the product. but we didn't hear about the team or the financials or the fundraise or all the other elements. And so it's just not a good trade-off. And you have to be aware that the product is, 15% of the discussion. And so you have to give it its share and then move on to the other elements, because the investors are looking at the whole business and not just the product side of it. It's a little bit of it's interesting, but they're missing the rest of the picture that they need to put out there for sure. This next slide I put together because I just wanted to recap what you're doing at each stage. And the implication here is what you do and the team you do and how you structure yourself is going to change over time. When you're in the pre-seed mode, you're out talking to a lot of customers and you're figuring out the markets, and you're trying to, once you finish that, you stop scanning all those different markets and you start focusing on the chosen market. And now we're going in starting to figure out how we're going to build that MVP and who's going to use it and how we're going to test it and so forth. And so the work changes every 6 to 12 months. And you have to recognize that in your planning, that you're not going to be just doing the same thing for the next 5 years. You're going to be doing different things every 6 months. And you need to be looking ahead to get ready for that next one so that you're building the team to help you with that. If I'm just defining the market and identifying target customers, I really don't need a coder. But when I start building MVPs, I'm going to need a coder. And hiring people is a 3-month process minimum to get someone there and in place. So in advance, you need to start anticipating what's going to come up in the next stage and how do I get my team ready for it, and how do we structure ourselves and organize ourselves to accomplish the new goal we finished the previous goal. And yes, you have to have funding for some of that, but you also need to be moving your team and system and structures into a way that you can actually manage it. When you get to Series A and you start growing it, you start looking at hiring admin people to offload a lot of the administrative tasks that they can do, so you can focus on closing sales and getting more product out the door. And so you have to start thinking ahead of what will my company look like in this next phase, and what's the best use of resources. Typically, you're trying to find the lowest cost resource that will accomplish the job for you, and what's the minimum amount I need to do to make things work. So because I need to be capital efficient and need to be very good use of the cash that I have coming in, so it lasts as long as possible. So all of these things have an implication on how you structure yourself and who you hire and how you run the business, and it will change from one stage to the next. Any thoughts or questions?
Can you go through these stages and sort of map out what you expect in terms of the number of employees or number of members of the team?
Sure. Pre-seed, I think it's 2 people. The founder and co-founder are out working the marketplace. At seed, it's 2 people and maybe a part-time administration person to start helping with some of the basics like mailings and that type of thing. Seed Plus, I think you have 3 full-time people. There's the concept that I've heard called the designer, the hacker, and the hustler. And that's where you come in at the seed stage, and the designer is actually designing the product, the hacker is actually coding it, and the hustler is the salesperson that goes out and raises money and sells the product. And the 3-person thing really starts to move the business forward because you're covering all 3 bases in a very integral way. When you get to Series A, that's really the CEO and the CTO and a product person that is at heart working on product sales and marketing. They're doing all 3 of those things to really generate that flywheel to get it up and going. And then you also have 3 or 4 administration people coming in at the Series A as well. So now you're looking at 5, 6, 7 people that are working on the business at that point. If you have $1 million or $2 million of revenue, you may need additional people to actually fulfill the product or service or do something of that nature. Series B, most of these companies are in the 20 to 40 person range at that point, because now they're located around the country. They're serving different geographies. They're working on different aspects of the product, which is now in scale. It becomes, the systems that support scale are typically much bigger. Instead of having one person handle the inbound calls, you now have a call center that's handling the inbound calls. And so everything has to scale up by by a factor of 10x. And so your team has to be managing those services that are actually holding the scale up there. Get to Series C, they're typically 50, 100 people at that point, and they go up from there. So it starts very small, but it can grow very rapidly once the product growth is there and the customer base is there as well.
So Nick is asking a question. Can you help me set expectations? Is it realistic to raise from angels for a pre-seed business with early revenue less than $5,000 a month?
I think you can. I think there are some angels that would come in early. I don't think they're writing you a 100K check. I think they're writing you a 25K check. And the thing you want to do is play the unit economic game with it. Instead of talking about the absolute value of your revenue, talk about the fact that at a unit economic level, you're already profitable. The number of companies, people, the conversion rates are known. You know how much money it takes to generate a lead, close a lead, and then fulfill the lead. And if you do that at the unit economic level, and that's a profitable story at some level, I think that's the way you spin that. And you ask for everybody for 25K checks. You don't ask for 100K checks, because that will come later. But I think you can get people interested in it. At heart, what you have to demonstrate is that I have it figured out. I know what the numbers are. I know what the conversion rates are. And it's basically a money pump. And you come in here, we'll be able to, we can scale this up very quickly with having more money come in, and I've already figured it all out. The thing most startups do is, instead of telling me what they've accomplished, they just forecast big numbers. Next year, I'm going to sell $1 million. If I came to you and said, I'm going to sell $1 million, would you believe me? Well, probably not, because I have no idea what you have right now. But if I came to you and said, if I have a machine that I can put this many leads in, generate this many leads for this amount of money, and close this many, and I've got this worked out, and I can do it at $1 million, is profitable, would you then believe me I could get to $1 million? The answer is probably yes, because you now have demonstrated that there's a system behind it that you have running that can actually demonstrate that. So at heart, what you're doing is you're showing the systems you built rather than just the number, the outputs that are coming out of it. So if you only have 5K, I wouldn't emphasize the 5K. I would emphasize the systems I have in place and how I can just turn the crank up on that with no change. It'll continue to work as it did before, and it can generate whatever money you want. And that can be a very interesting story for investors.
Thanks, Paul. That helps a lot.
Sadly, we end up not really bounding our cost of customer acquisition by the time we're already in Seed Plus, right? And so there's a certain amount of chicken and egg in what you just said in terms of when I can actually bound all of the variables in my unit economics. But I should have data for all of those variables, and I should be able to show the variance in the data. And you should show that you're making progress on the variance and getting it smaller and smaller and getting clearer and clearer on those things. So I may not exactly know my cost of customer acquisition, but I can bound it. And if you've got some kind of control on it, which means that you've got some kind of metrics that you're tracking, then you can get there. And this is one of the places where I think investors and companies get mixed up. We would like you to give us as close a bounded number as you can, but having some metrics at all that tell us where it's at is useful, right? And so you think we mean an exact number, and we just want a bounded number.
Right. Yeah. So if you've done enough tests, enough cohorts, and you can demonstrate that this is a repeatable, predictable process, and that's what we teach a lot of people, especially in the Seed Plus, is you want to create a pipeline to show how many leads you generate at the top, how long it takes to go through it, what steps you are to generate the lead, close the lead, qualify the lead, close the lead, and what those conversion numbers are, how many % go to each next stage. And then that's the story you tell to the investors. We have this machine that's up and running at some level, and then just start showing the deals coming through the pipeline and what they're worth. This group is worth 50K, that group's worth 75K. and then track them through to show that this is coming through in the time frame you predicted and you're getting the revenue you predicted. When they start to see a complete loop on it, then people start to really get excited because, oh, I see this now working, versus I'm going to forecast this, but I've never actually done it before. And that really goes nowhere, of course, with investors. Let's see.
Any other thoughts? No? All right, go ahead, Hal.
Yeah, so I put in the chat box earlier a link to the e-guide. So if you want this presentation, you can just go there and download it. Anybody with a link can get access to this e-guide. It's at the beginning of this chat format. And happy to answer any questions people have now. If you want to reach me afterwards, I put my email in there. And glad to give you feedback on your business or your idea or what have you. If it relates to this stage, happy to give you more background as to how we came up with some of these numbers. We work with startups around the country and been doing so for a long time. And like I say, there are variances out there. You know, those on the unicorn track, those on the biotech track can see some different differentiations. But you know, for standard businesses that most of us are doing, I think this is what you normally see out there. And the key is just to realize that at each stage, it's going to be a different game. And so you just want to get ready for that and put that into your planning and forecasting so you know what needs to be done on the next level and how you're going to do it with the team that you have. And not to get too far ahead of yourself on valuation. It's exciting when somebody says, hey, I'll give you a doubling valuation. Realize they're not doing you any favors. You really have to, whatever valuation you get now, you have to double for the next round in most cases. And if you can't do that, you could be in trouble in raising the funding that you want. Now you're up for bigger dilution than you had expected originally. So you want to make sure that you keep your valuation on the right track and your fundraise on the right track and keep the focus that you have. Any other questions at this point, guys?
I have one question. So when you are working on your market size and market opportunity, what is like a range number, like reasonable range number for your TAM, SAM, and SOM?
Yeah, so the total available market should really be a multi-billion-dollar market. That's anybody that could ever buy your product. And then the serviceable market usually is 500 million to $1 billion marketplace, because that's the target market you're going after. And then instead of SOM, I like to use what's called the beachhead market. And I do this because I see these big booming numbers out there. You know, telecom is a $1 trillion marketplace. And my fear as an investor is we're going to get lost in there somewhere, not finding the right market. We're going to be casting about. And what the investor really wants to know is, who are the first 20 customers you can go talk to? And so I put the beachhead market up there instead. And the beachhead has, some segment. It's either by geography or by sector. It's got a list of about 20 company names. And our beachhead market is this group of people. Oh, by the way, I've already talked to all of these guys and they're signing up to buy our product. Oh, that's what we want to hear. Our go-to-market is a logical path into it, and we know where that is. You never want to talk about getting 1% of the total available market, because that doesn't demonstrate how you're going to get in the market and where you're going to start. And the fear the investor have is that we're going to get lost in this market. We're going to be chasing this group and then that group, and this group is separated from that group, and there's no logical format to go in. And so what you need to do with the beachhead market is to, instead of talk about dollar size, talk about specifics that you already have accomplished. So you have an entry point into the market, and it serves as a go-to-market slide. This is where we're going to start. And it gives the investor confidence that we know what we're doing to get into this market. And once we're there, we can expand out to these other areas. There's plenty of growth to be had here, but we do know where we're going to start. And I don't find a lot of go-to-market slides. I find a lot of big market bubbles that says it's a big, billion-dollar market, but how are we going to actually get there is a question mark that's in every investor's mind. When we leave today, who are we going to go talk to? So if you've got leads or you've already generated that, you want to give yourself credit for it by mentioning it in some way, shape, and form.
Yeah, beachhead
Thank you so
markets make a
much.
lot of difference in that conversation. Marav has her hand up.
Hello, everybody. I'm talking from Israel. And I started my venture in Israel. As I said, we already have MVP and we have several pilots. My question is, investor in other countries, they don't know this market. This is only pilot here. So how can I give them confidence to invest in my venture? And maybe investor in US or other country.
Well, if you have an MVP, you have some results with it. You know, how many people used it, what they said about it, how it worked for them, how many are signing up to buy the final version. You want to run cohort tests to show all the characteristics around it, just so you get the benefit of the lessons learned. And at heart, what the investor wants to know is, do you know your customer very well? I talked to many startups, and they tell me I haven't talked to any customers, but I'm building my product as fast as I can. And I'm thinking, why are we building something without talking to the customer? The first thing we should do is talk to the customer and then take that information to the investor. So when you're pre-seed, you go to the investor and say, we've been talking to IBM and they have this problem over there that's costing them this much money and they're looking for this kind of solution. And then you come back at the seed level saying, well, IBM has decided to give us a $150K project fee to go and build a solution. It's not everything, but it's going to solve a big chunk of it for them. And what warms the heart of the investor is the knowledge that you are in contact with the customer and you are related to the market. And so if you have an MVP, it's less about the product and more about what the customer is telling you, what you know about the customer, what relationship you have to the customer, and the knowledge that we understand what the needs are and we understand how we can solve their problem and build their product for them. So I would always take to the investor the customer discussion in addition to the product discussion, because the customer discussion is what's going to close them. Product discussion we have to have because we have to build something, but the customer discussion is the one that investors are listening for, because I want to know that customer is going to buy the product. And if you're not talking to them, that scares me, because you're probably going to be building the wrong thing. And 90% of the startups I talk to are building it first and then selling it second. And my rule is we sell it first and then we build it second. We go out and we see who wants to buy this thing. And if nobody will buy it from us, then we're not going to be building it in the second place, because there's no market, there's no need, there's too much competition. There's some reason why we couldn't sell it. So I take the customer story to the investor in no matter where you are. If you're in US, Israel, or wherever, take the customer story and the dialogue you're having with the customer for it. That's why the anchor client is really helpful, because they can really foster that customer story very well. And if you don't have an anchor client, get 3 to 5 customers and make them your anchor and get that dialogue going, and then take that story to the investor and what they're saying about it.
Thank you very much. I did it. So thank you very much.
Okay, thanks.
So Hall, are you investing outside the US?
Not currently, but I get a lot of calls from Africa, Israel, Europe that look like very interesting deals. I was joined a incubator pitch session in Romania the other day, Western Romania. It was just like the US. Everybody spoke English. Everybody had AI and drone and blockchain deals up there, and everybody had a 10-minute pitch that looked just like it was in, Peoria. It was just amazing. It just looked like everything else. So I think it comes more and more that people will invest outside, because valuations are much better there. I think you find entrepreneurs that are hungry there as well. And so I think there's some good deals to be had.
Yeah, absolutely. Any other thoughts from people before we call it the day?
Just a thank you to both of you. Very, very wonderful conversation today.
Great.
Cool, thank you. So we're doing workshops over the summer. And every Tuesday evening, we're doing workshops, and every Thursday noon. And so on the meetup group, the Seattle Angel meetup group, we have all of those. I would encourage you to take a look and engage with them. I would also say that we're trying to record all of them, and we're trying to put them onto the YouTube channel. And so if you would go to the YouTube channel and sign up, that would be really useful for you to see them as they come on. And for those that are sort of scratching their head on some topic and they want to talk more startup-y, every Tuesday morning we have a open coffee where we talk about startup things, whatever's on people's minds. So I put the link in there. So if you go to the bottom of the chat, there should be 3 little dots. You click on the 3 little dots. You can save the chat and you'll get all the links and all the stuff that's gotten put in the chat. So thank you very much, Hall. It was great to have you again. Always love the conversation. I look forward to doing more things with you. And for those that are internationally inclined, we have the first Transatlantic Angel Conference going on in July 7th. And so we'll see whether we invest in the Romanian plant-based sashimi company or the Israeli-based video monitoring company. Who knows? Thanks very much.
Thank you guys for having me.
John,
Enjoyed
thanks,
it.
Hal.
Great questions. You know, hit me up if you have any questions, but thanks so much. Really enjoyed it.
Thank you.